Welcome to the Finance Geeks, a podcast about real financial planning. Join us as we get into the nitty-gritty, discussing everything from pensions to portfolios. If you're into numbers, strategies, and running a successful practice, this is your ultimate geeky hangout.
Welcome to Season 2, Episode 9 of the Finance Geeks podcast. Thanks for joining us. My name is Warren Shute. I'm here joined by...
Paul Cleworth!
That's a great Paul Cleworth. Today, we're talking about how we invest behind the scenes of our portfolio management. But before we go into that, Paul, what have you been up to?
So, Warren, I was because we're filming and it's a Wednesday, I was at the gym this morning with Juan, my trainer, and we did shoulders and triceps. And I felt really good. I actually had a really good workout because I tried harder. I felt stronger. I'm going to include in the show notes, guns. I'm going to include in the show notes the actual workout itself because he gave me a compliment this morning. He said, and I was really conscious of, I'm 48 now. I think I'm getting weaker. But how do I compare to other 48-year-olds? And he said, he was just giving me compliments.
Has he got an accent?
Yeah, of course he has. He's from Argentina. Yeah, he's Spanish.
Give me the accent.
No, I can't. I'm terrible at accents. My wife will tell you. When I try to do a Welsh accent, it sounds Pakistani or something like that. Well, she's Welsh, and I try to come here, Alison, come here. And anyway, I'm terrible at accents. Let's not get into that. So, gym this morning. What else? And on the theme of fitness, I wrote a post just the other day on LinkedIn about Jeremy Clarkson. It was the reason why was there was an article about him in the Times about the fact that he's mid-60s now and I think he's got stents in his heart, but he's trying to do Pilates to keep fit because he wants to be alive longer for his grandchildren. But it just reminded me, and I was asking all these rhetorical questions in there. You can have all the money in the world, but if you don't have your health, you don't have anything. And so I was mentioning that, and it's got some traction, a couple of thousand views. Thirdly, I've been listening to lots of 80s music recently.
Nice.
I'm Simple Minds. A lot of what else have I been listening to? Simply Red. All the S's. Yeah. Style Council. Yeah.
Nice.
And I've been watching some 80s movies. I find that a lot of the new movies now, I watch them, but I just really like watching 80s movies. So Airplane 2, oh my Lord, it's probably the best sequel of all times. 1982. Robert Hayes as Ted Stryker, Lloyd Bridges as Steve McCroskey, and William Shatner, Star Trek, as Commander Buck Murdoch. I mean, there's so many amazing scenes in this movie. The greatest spoof of all time. It's the biggest recommendation. If you've not seen Airplane 2, you're missing out.
I've not seen Airplane. So
right, that tells me a lot.
Do you have to watch that to watch Airplane 2?
You don't. Well, it's probably better if you do in that order. Right?
Does the plane crash?
I can't. I'm not going to tell you what happens.
Okay,
but go on.
I'm just about to go off to Paris. Okay, I'm thinking, I could download it onto the iPad, but I don't want to watch it.
No, it doesn't. It doesn't crash. They land the plane in the first one, and the second one, obviously, it's they go on a space shuttle to the moon. Right? You're thinking, okay, what's that about? But the one of the best scenes, right? There's a scene where there's a prosecutor and a witness, and he's talking about the time when he was with Ted Stryker over Macho Grande, and it ends by saying, "Over Macho Grande," and he says, "No, I don't think I'll ever get over Macho Grande. Those wounds run pretty deep." There's so many quotable lines for it. Okay, the last thing before I hand over to you is that my building in the back garden, affectionately known as the Stables, is taking shape. It's going to be a sort of filming studio, staff rec room, events room, and we're looking to put on an event in June because I'm hoping it's finished by end of April, early May, where we're going to get Charlie Hodgson, who's a sort of ex-England rugby union player, played for Sale Sharks, Saracens. He's a friend of mine. His kids are my kids, are good friends. And he's going to come do a speech for some of our clients. So I'm going to promote that and try and get 30 people there. Good. Exciting, yeah. Cool. What about you, Warren? What have you been up to this last few weeks?
Mate, it's birthday celebrations at our house. So Bella's 18 tomorrow. I can't believe my daughter is 18. Wow. So we all went to the Fat Duck last week, had an experience. It's not a meal, it's an experience.
What's the famous chef? Blumenthal. Esther Blumenthal. You went there. Did you have to take out a mortgage to pay for it? Was it like £1,000 meal or something?
Hey, do you know what? You do, but like I said to my wife, why do we work? If we're not going to celebrate these events, these milestones, if an 18th isn't a milestone, why not? So my wife and I went many years ago, 7-8 years ago, and the kids were too young at the time. So it was great. It's not.
Is it worth the hype?
Yeah, it's an experience. I'll tell you one thing we
Yeah.
did. I did the wine tasting there as well. So just Nikki and I went off into this room with them, and they played different music, and you're trying the same wine, and you notice how the wine tastes different, notably different, with different music they play.
Wow, you're
The
kidding.
more aggressive the wine, the more tannins. Sorry, more aggressive the music, the more tannins in the wine. Softer what music, very smooth wine. I swear on my life,
Wow.
it's fascinating. He's a scientist. He's a genius, and it was fantastic. So that was then. That was last week. Today, this afternoon, we're going off to Paris for a few days, and her birthday's actually tomorrow, so she'll wake up in
With
Paris.
Bella?
With
Just the
Bella
two
and
of you,
Nikki.
or there's a family?
Three of us. And Nikki,
Oh,
yeah. Ollie's not going. Ollie's actually at uni, so just the three of us. So yeah, looking at that. But so I'm really, really looking forward to that. But then you mentioned films. I watched probably one of my favourite films ever, 688. Have you seen it?
What?
So it's a new film, 688. It's about
No, I haven't seen it. Who's
it's
in
about
that?
it's about a battalion, no particular famous actresses or actors, about a battalion of black women in World War II, how they were discriminated against and sent out to Europe to sort out the internal post for all the troops. And it's basically
Really?
they were given 17 million pieces of post to process in 6 months, and they thought they were going to fail, and they processed it in 90 days. And
Was that on Netflix or Prime, or where did you get that?
I think that was on Netflix. I think it was on Netflix. Yeah, really recommend it.
688.
688 It's the name of their battalion.
Oh, tremendous.
And on the fitness side of things, we're probably now into week 3 of 75 hard. I think we finish.
Are you keeping it up?
Yeah, 100%. Yeah, so 2 workouts a day, one outside, at least one outside. Sorry, no alcohol. The best thing for me is reading 10 pages every night. I used to think I read a lot, but I obviously wasn't reading 10 pages.
And it's of non-fiction, is that right?
Yeah, completely. Yeah, non-fiction.
And what have you been reading then?
So the book I'm reading at the moment is called Intention. So the previous book I read was Bill Gates's How to Solve Climate Change, something like that. But this one is about intention. It's about living life intentionally. It's interesting.
And do you read before you go to bed, or do you read sometime during the day and set it aside in your diary, or what?
So New Year's resolution for me was to leave the office between 5:30 and 6 because I genuinely enjoy my work. I could carry on working into 7 o'clock or something like that. Honestly, so this year I've left the office between 5:30 and 6. I go home. Sometimes I have half an hour or so where I'll read while Nikki's picking up Bella from the train station or school.
Okay.
But most of the time it's in the evening.
Do you know, I took your advice and I bought a Lumi light.
Yeah,
so I tell you what I do like more. I like the sunset. You press it and then you got 30 minutes and the light gets from bright down to dark, and it does make you go to sleep. So I also have these 2 sleeping pills 30 minutes before bed, and we time it watching Yellowstone, which is now on Netflix.
Okay,
It's Kevin Costner and all the rest of it. I'm surprised how many people die in the first few episodes. I was like, is this what it's really like in Montana on this farm? But it's actually quite watchable. And and then in the morning, it doesn't work for me every morning because, it rises. This morning I'd used it because it starts at 6 and then by 6:30 it's light. Yeah. But I don't want to do it Monday, Wednesday, Friday because I get up at 5:15. And so my wife would be like, what's that light? She doesn't get up at that time.
So how do
I
you
get up for the gym.
How do you wake up if you don't use that?
I just use a normal alarm.
But doesn't that wake
on my phone? Well, I'm one, when you set your alarm and then I always say I wake up like 2 or 3 minutes before, and it never actually goes off because my internal body clock goes, you need to get up at that time. So 5:12. Yeah, machine. There you go. Thank you. Yeah.
Hey, shall we move on to the main focal point today, where we're discussing how we invest behind the scenes of portfolio management? So, Paul, big subject, lots to go through. I'm sure we're not going to cover all of it today, but where should we kick off? Where do you want to start?
Well, I originally thought we would talk about our investment philosophy because, and maybe just a transition over the last 20 plus years as to how we've decided on the way that we invest. And I know we both use evidence-based investing, index investing, and I'm sure our listeners will know largely what that is. But over the last couple of years, especially, since I set up Tandem about 8.5 years ago, it wasn't until probably 6 years ago that I got developed a one-page document that specifically said, this is our core investment philosophy. And I put it down into 10 points. And I got a bit of help from Dimensional, a bit of help from Vanguard. And it's trying to explain it to a client, very, very simply. Because I've understood that the perception from clients' point of view when they come in, if it's a new client, for example, of what they think investing is, and it is radically different to what my perception is. And they perhaps they think it's buying and selling constantly, and maybe they think it's buying direct shares. It's a combination of 50 different assets. It's using a platform or using a life insurance company. And so we almost have to go backwards and really explain it from the beginning to new clients what it is and what it means.
For me, we have an investment presentation that we give about 30 to 40 minutes long. And for most clients, that's a very slick, easy process, unless they've been referred to us by SJP. When they come to us from SJP, which we do, we're near the SJP's head office, we do quite a lot. We have to re-educate them on the forgive my language, but the brainwashing they've been given over the past isn't actually working for them. So they're very like, what about, one meeting a year? We need to time the market. We need to do this. What happens if the market crashes? When are you going to sell? We're like, well, okay, we need to re-educate you on this. So
and it sounds patronizing in a way, doesn't it? If you don't use the right language, you're trying to educate people and, as you say, change their misconception. Because SJP, Goliath of a company, 150 plus billion or 200, whatever they are, enormous. But they are restricted advice and they have internal funds that they'll use. They use SJP funds. And when you look at the data, the majority of them are third and fourth quartile. And I think that a long time ago, this was actually 2008, and I've been an advisor since 2000. But in 2008, we decided at the time at my previous firm, right, we will create some model portfolios. How should we do it? And long story short, then we had 20 funds in the model, and we started off with majority of actively managed funds.
Yeah, I was going to say, were they active? So when I started out as well, we were actively managed. I can remember in the good old days getting Money Management magazine, the back pages with all the performance. We'd have a ruler and we'd go down and looking for the top sort of quartile performing funds and picking those out and doing what we thought was asset allocation, putting these funds together, fixed income, etc., and equities. And on reflection, everything's wonderful in hindsight. Actually, 30 plus years ago, that was, we could have done it a lot better. And how the market's moved on.
Pre-credit crunch, 07, 08, I remember choosing funds from Scandia's, now All Mutual, whoever they are now. So, this fund guide, and you were looking at the way that they were rated, their quartile rankings, their alpha and beta ratings, their R2 squared or whatever it was. I mean, all these ridiculous ratings. And you would say, okay, it's obvious, isn't it? This one's done really well over the last year, 2 years, 3 years. I'll have that one. And you can easily construct a portfolio based on how it's performed historically and say, oh, this is great. You should totally invest like this. And you could have chosen, as long as you've got a fairly well-diversified portfolio, largely of equities, virtually everything would have done quite well between about 02, 03 and all the way up to 07, 08. And I remember picking them because there's no school that you go to, there's no course that I ever recall the CII or the CISI doing that says this is how you do it, this is how you select funds, this is how you build a model portfolio. And then there's a realization when there's a shock in markets, when there's a big decline, that some of those actively managed funds absolutely crash through the floor.
And I think it's fair to give Dimensional credit here and give them a big shout out, a bit of kudos that when they came into the market in the UK, which now was about probably 21, 22 years ago, I think, they re-educated the financial advice population of, okay, this is really how true investing, how real investing is done. And I think they did a tremendous job. And although we're not 100% dimensional in our approach, we give them a lot of credit for helping us raise our game significantly. And we definitely include them in our portfolios.
Yeah. They used to say, we had Sam Adams back in the day come to our office. Do you remember Sam?
Oh, yeah.
And he used to brilliantly explain it as to how the markets worked and the efficient frontier and how to, capture returns in markets and the 3-factor model, now 4-factor. Anyway, it was originally, they sort of said, you need to use us and only us. And 100% dimensional. And then they changed their tune a little while later, said, okay, well, you can have us included in your models. And I think they realized that it was difficult to be 100% dimensional, albeit some advisors are. So like yourself, we use largely dimensional and Vanguard in our models. Yeah. But it was about 08 that we transitioned to model portfolios. And then as we developed them, we reduced the number of funds down from 20 all the way down to about 10 or 12. Now, at Tandem, my firm, my portfolios are the the trails portfolios, the tandem risk assessed investment levels. There are 7 core model portfolios and 7 trails ethical models. And there's only a maximum of 7 funds. They're all evidence-based, index-based, passive, low-cost based. And we've just refined the process over time.
It's interesting. And you're absolutely right. We were going from the active, and then when we started the passive journey, we thought to justify ourselves, we needed to include more funds within there. So, and also, we were doing this back sort of 20 years ago when there wasn't a world allocation fund. You had to buy, a UK market, an international market. And I think back in the day, we were using Legal and General and Norwich Union. And then we could get the small cap and value from Dimensional and stuff like that. Now the market has matured so much that it's, a plethora of good quality, low charge.
Plethora, good word.
Thank you, Paul. Thank you. I try to keep up with you. I'm just chasing your tail. But there's a lot more availability, and I think we're using the word model portfolios. I hope a lot of listeners are using models because it gives you consistency within your firm at delivering advice, particularly if you have a range of advisors, rather than them all choosing different funds and portfolios together. That this is what the investment committee agree on. This is the best way forward. It doesn't mean you're rigid to that. You review your portfolio. We review ours every quarter, but you just have a one-way system of delivering it.
It's you live and learn, and as an advisor, you develop what works for you. But I think that what it explained to what I learned over the years was I didn't want to try and demonstrate my value as a financial planner, which I think I've transitioned to ever since really 2011, 12, 13, when I stopped doing mortgages and started doing proper financial planning. I don't want the clients to judge me based on performance, albeit a lot of them still do. I don't want them for me to try and bamboozle the client or suggest in some way that I've got a crystal ball and that my models work better than others out there. I've seen a lot of other portfolios from active fund managers, and this is not me saying one's better than the other. I don't want this to be a debate of active versus passive. Both can absolutely work. But in terms of me presenting what we do, all I really want the clients to do is to understand there's a way of getting to capture returns in the market with using the free lunches. The free lunches are keeping costs low, asset allocation, diversification, and investing as per world market cap. So, you've got to have some kind of system and strategy as a business and stick to it, a methodology of how you invest, and don't go off-piste.
I think you're right about, active and passive potentially could work. What we're trying to do for ourselves when we're using a passive is take a risk off the table. It doesn't matter how you look at it. An active manager is making a decision on what they feel is the best move forward. And if we try and get predictable returns, taking that risk off, that decision-making process off the table and say, hey, look, we're going to buy the market. The market's delivered us a great return. It's positive 3 years out of every 4. And when it's negative, it's normally negative single digits. Hey, we're okay. It's averaged around about 9-10% return a year. That's good. That's a good return for us. Let's focus on the other areas.
Yeah, but this we're talking about now behind the scenes of portfolio management and how we construct our models and our investment methodologies. But a lot of it again comes down to client perception and how you set expectations of return. So you talk about investments with clients and you explain what investing is, and you say, "Oh, right, it's 7 to 10 years plus. It's time in the markets, not trying to time the markets." And you'll use phraseology like that. You'll then explain the difference between equities and bonds and stocks and shares versus fixed income, and instead of what I've learned over the years, instead of talking about risk and saying specifically, this one's low risk, this one's high risk, we got rid of our risk, the names, cautious, confident, moderate, adventurous. We got rid of all of those 2 years ago now. And because people would look at them and say, well, I think I'm moderate, I think I'm confident, I'll go in the middle somewhere. And you're educating them about investing and they never want to go at the top end, which they consider, highest risk. Whereas all you really need to know investing, in all honesty, is equities are the driver of return. You need to have a high level of equities if you want growth. I think that if people look at the last 10 years and say, oh, I wish I'd been invested in the S&P 500 as my sole investment, I'm saying, well, that's easy now to say that with the benefit of hindsight. That's investing and driving using your rear view mirror. Anyone can do that, and saying I should have done this. But moving forwards, how can I capture an optimal return that's going to help me achieve my financial goals? We're not trying to shoot the lights out, is what I'm saying.
Yeah, a couple of years ago, we moved away from the 80, 70, 60, 40 sort of portfolios. And we basically just have now 2 portfolios. We have our bond in cash and we have our equity. And we don't insist, but we encourage our clients who have got, as you said, 7 years or so more. We typically draw it at 5 to be 100% equity. And then any money that they want to draw down, hold that in cash and bonds for the next 5 years. Now, you're right, not every client can stomach, sit in the market with the extreme volatility. So then we might soften it down with a bit of fixed income. But generally speaking, we try and encourage clients to go into the 100% equity model. When we talk to them about volatility in time, volatility tends to dilute over time. We talk to them about investing, not just necessarily for their time horizon, but also their children and potentially their grandchildren. These people are going to inherit this money. So it sort of dilutes out the volatility that way a bit.
Yeah. That balance is hugely important, and I think the value an advisor can add to a client is the understanding, helping the client understand their perception of risk, helping them understand what investing is, and then getting that balance correct across their circumstances. So for example, you meet a client who happens to have a particularly good final salary scheme. They're going to get probably a state pension in their late 60s, and this income together, maybe they've got rental income as well, but these forms of income will cover a lot of the main requirements for them, their living expenses later on. That person can theoretically, especially if they're in good health, understand equities and the risk associated, can absolutely take 100% equity in their portfolio. They can withstand that level of volatility because they've got these other streams of income. If on the other hand, your entire income stream, which is return of capital in retirement, if you're 60 plus, is your investment portfolio on a platform, whether it's ISA, general account, pension, whatever it is. In that scenario, I'm very big on making sure that clients have got a reasonable amount of cash, enough to cover capital expenses and short-term investing, enough cash for 6 to 12 months of income, and then they can still be 100% equity as long as they understand, the strategy of withdrawal and what markets do and how they perform. But I've found that a 70-30 model or 80-20 model for the majority of our clients that are late 50s, 60s is optimal in terms of the potential for return and the volatility risk.
And if you would look at ours under the bonnet, that would probably coincide because typically we're talking about a 4 to 5% withdrawal rate. 5 years, so 4% over 5 years is 20. So an 80-20 model will sit there. Or if they're drawing 5%, 5, 5, 25, so 25, 75 sort of model. So yeah, although we maybe come at it slightly differently, the outcome actually probably is very, very similar. And then something else that we're quite keen on is if the client has multiple equity funds within their equity portfolio, just making sure the rebalancing is kept in line. We don't do a lot of rebalancing, but we're quite happy to rebalance it at market extremes. So
how often do you rebalance?
Not often, to be fair. It depends. If I'm honest, it's more often strategic rebalancing. So if the markets sort of plummet, we're probably more keen to sort of buy into equities, that kind of thing. When the markets are high and the client's a bit lower on cash and bonds, we're more happy to sort of offload.
If you had 20 clients and let's say everyone had 5 million, right? And you're giving and you're able to that's almost like the optimal for any sole advisor. Each one's got 5 million, 20 clients. As long as they're all committed and you're educating them, that can work well. But the point is you can give those individual experience of when to rebalance and so forth. If instead you've got hundreds of clients and we have something like 350 clients, 210 client families, you need a system, you need a process to be able to communicate what you're doing with all of them. So just recently we sent out our Trails Bulletin at the end of this month. It was the 31st of Jan. We do one in winter, one in July and for summer. And it was an email that said, click on this. It's our model portfolio review. We're making one change. We're selling this fund. We haven't got DFM, discretionary fund management, so we need their permission to sell a fund. But we rebalance every February. And the reason we do it is a couple of reasons. One, it's to sort of regulate risk and put the bond and equity proportion back to the model, which is locking in returns arguably and moderating risk. The second is it's topping up cash back to 2%, which is good for the client and us because we don't have to sell down the last fund bought. And three, it actually demonstrates you're doing something because there's loads of evidence to say don't rebalance until it's 10% out of kilter, wait. And it's actually a lot harder then. I think it can work for you historically because you get more equities typically and they perform better. When there's a market decline, if you're massively out of your model, you've just got to be prepared to accept that bigger
Yeah.
decline in drawdown in your portfolio. So yeah, we like to do it annually in February.
Yeah. So yeah, I think the strategic side of things, rather than, and there's lots of good firms out there do it every calendar year or whatever it might be. We're very keen on doing the capital gains tax planning. So we have quite large GIA portfolios. So it enables us to do sort of sales when markets low, realize losses.
But that's why it's good to do it in February, because you're prior to the end of the tax year. With the big general investment accounts, we sort of say, do tell us if you've used some or all of your CGT allowance already this year. And we'll, especially for ones over now about 150,000, we have to look to make sure if you do an auto rebalance back to the model, that you're not going to unnecessarily incur CGT.
It would be a worthwhile episode, maybe talking about the different wrappers and capital gains planning and stuff. And if you're a listener, that would be worthwhile to. Please let us know, because we don't really know what you want to hear. But talking to the wealth managers at the CISI meetings, so we have local meetings around there, they typically will sell 2% of the portfolio every year, period, just to keep capital gains tax under management, because it certainly can be an issue, portfolio growing in value, that kind of thing.
Well, as part of our discussion on our under the hood, if you like, and under the bonnet of portfolio management, yes, we both use dimensional and Vanguard funds. Yes, we both use low cost evidence based, which is what they are, index funds. You can call it what you want. I don't like the term passive. I think it suggests that you're not doing anything or there's nothing going on. I prefer evidence based or index. I absolutely believe in strategic asset allocation, buy and hold, because a portfolio of active funds or an investment manager, a wealth manager, a firm like Barclays or whoever it is, that's buying and selling constantly, you're going to get a bigger portfolio turnover.
Yeah.
You're going to get, they're going to buy the sell the losers, buy some that hopefully will perform better. Lots of buy and sell costs, unnecessary costs that you're going to include. So don't like tactical asset allocation, prefer strategic asset allocation. And I differentiate with clients and say, look, we buy and hold.
So you mentioned your tandem portfolios. I think what we also do is have the mirror portfolios. So we have non-ESG standard in mirror, and then ESG standard in mirror. So if a client comes out of one for its capital gains tax planning purposes, they can go into a mirror portfolio and still stay. So we're ESG by default. So unless a client has a preference, otherwise they'll go into an ESG portfolio. And that's not necessarily because of environmental reasons, although clients often would buy it or confirm with it. It's more that there was a McKinsey report out to say that the best brains coming out of the best universities in the world are going towards more environmental sustainable companies. We kind of feel, okay, this got more of an edge that way. And up until Trump got into power, governments were really backing the Paris Agreement in incentivizing carbon neutral or carbon negative incentives. Don't get me wrong, this is really on number one on the agenda at the moment. Since Trump got back in, every investment review, we're monitoring it. But our ESG portfolio has outperformed our non-ESG portfolio 5 out of the last 7 years we've used it.
Wow.
Yeah.
I know ours, that we've only had ours about 5 years. In the last 2 years, our ESG models have outperformed the normal trails models a little bit, it's amazing. I think there's a perception, isn't there, that ethical or sustainable or ESG type models or funds don't outperform, that they're much more expensive. But now you can get all of ours a low cost evidence based as well. We've decided we've got an iShares, a BlackRock fund in there, one and the same thing. But again, it's dimensional and Vanguard largely. Yeah. We used to have more active in there because you only used to be able to get certain index-based and active. Other thing I wanted to touch on here is our preference for using unit trusts and OICs. Because I don't know about you, we don't use ETFs or investment trusts. Do you use either of them?
Yeah. I'd be okay to use those. I don't really. In fact,
in your models, you use them?
No, I would use them. I would use them. Yeah, I would use them. Yeah. So particularly we're in dimensional stuff like that. But in dimensional's drive in the US is to go ETFs. So they're mainly ETFs in the US. And I think principally that's because people like real pricing. So, okay, what's the price of my fund right now? Let me get out of it, rather than waiting and selling it and getting yesterday's price.
Well, they're daily priced, aren't they? They're daily traded instead of unit trusts and OICs, which are priced once at the end of the day.
Yeah, so they're live pricing. So you can trade it, you can trade an ETF immediately and just sell it like a share. So you know what the value is. I think that's the way things should go, if I'm honest. The whole point that we got to wait until the end of the day or the next day to get yesterday's price is a little bit...
There is that, but that goes against the notion of buy and hold for the long term. And so you find that the reason why we don't use ETFs is partly because you have to buy one share, you have to buy one price of it. And if clients are doing 20, 50 pounds a month regular contributions for their kid or for themselves,
Yeah.
you sometimes can't put it in the models. It doesn't work. There's also types of ETFs where I don't like the underlying structure. How is it protected? Where's the actual money? And is it a synthetic ETF? And they're just overly complicated. I like the structure of an OICO unit trust where it's a 10,000th of a unit, and you can buy, £1 in it if you want. But unit investment trust, a lot of data that shows that closed-ended investment trust, closed-ended funds can outperform, and some of them have done. Again, it's down to complication.
It's the gearing typically. Investment
The
trust
gearing, the
borrow
discount,
money.
the pricing, the par
Yeah.
value. I mean, all of the ways that it's priced, whether it's at a premium or it's at a discount. Again, it's just another complication and something you have to explain to clients, and that's part of why I don't like it. Plus, they're closed-ended. I like open-ended. All of our funds are 0% initial. Virtually nothing to get in, no exit penalties to sell, and I love that transparency.
Yeah. No, absolutely. No, completely agree. And I guess, a big question under the bonnet really is a phasing of investments. You've got a client who's got £1 million in cash, sold their business or whatever. How do we get this into the market? Do
you phase buy a lot for lump sums?
It depends on the client. My advice is no. So typically, client says, I want to invest this. I said, do you have a preference over how we go into the market? If they ask me, I say, well, look, let's just go into the market. The expected return of the market is 9-10% return. The expected return of cash is what, 3, 4. Let's just get in the market. We're just, prolonging that exposure until we get it.
Don't look at it for a year.
Yeah, but then also you got to have the question to the client and say, hey, look, the market volatility could be say 30% in a year. How are you going to feel if that 1 million goes down to 700,000 within the first year before it starts recovering? If they're quite comfortable with that, if they understand that, then that's fine. If they're going to feel jittery, then I'm very happy to phase it in.
Hey, listen, almost always with lump sums, if it's a sizable lump sum, whatever you deem that to be, let's say that's 100 grand or above, I'd phase buy over 4 periods. And so I'll say to the client, my preference, my thoughts process is phase buy because you can't really lose out. And that's only in hindsight. So for example, you phase buy 100 grand, 25 grand today, 25 grand next month. It's over a 3-month period, but it's 4 investments, 25 times 4, right? So it's over a 3-month period. You're buying obviously into the market at different points. You're pound cost averaging. If the market goes up, you're still going to make money. If it goes sideways, it's no different. If it goes down, you're buying when markets fall. Only if it continuously goes up and you look back and you say, oh, I would have been better off buying it initially. But I say, look, I like phase buying with lump sums because it's going to reduce the risk associated with market volatility in the short term. In the short term, I think it's better for the advisor, in all honesty, and the client, certainly the advisor, because you can't do any wrong. If the client puts £1 million in, invests immediately, and the market declines 30%, they'll be like, oh, why didn't you tell me?
Yeah.
I did tell you, we went through it, So it's protecting me as well.
I guess I just look at it from a logical perspective. The market's up 75% of the time. You're much better off being in the market.
Invested.
Just get up.
Let's talk about property and commodities. Do you include those in your models at all? We use equity and bonds, I know. Property and commodities, do you use them?
No, neither. We kind of look at the property side of things as saying clients have an exposure to property. Most of it is quite a large property. Most clients have paid their mortgage off, that kind of thing. Some might even have commercial. So we kind of feel they got property exposure there. And commodities, we don't deem as an investment. They're a commodity, and they'll fluctuate based on supply and demand. And that's often due to politics and stuff. So we don't include either. So no gold, no oil, no cryptocurrency, which we'd put in the commodity basket, and no property. How about you?
We used to have a commercial property fund, what was the BlackRock, or iShares Global Property Fund, and then they changed the name. They sort of greenwashed the name. It became so long and confusing. No, the reason why we got out, we just thought, look, interest rates were on the way up. This was a year or so ago that we got out of it, and they're high. Is it worth having that specific allocation to this fund in the models when we have something like 27,000 securities overall of equity, individual stocks and bonds in the models anyway? So there was replication, there was overlap, and I just thought it was a bit too volatile. The fund, if you'd got it for the exact right perfect point, it might have done all right. It's done about 8.5%, that fund, in the last 12 months, whereas equities have done generally a lot more in the last 12 months, 15 to 20% plus. Depends whether you're in global equities or whether you're just in the American markets. But yeah, it didn't make sense. I think that you only really need equities and bonds in a model, in the various models. And I think that we're handcuffed to a large extent by the FCA because you get wrapped on the knuckles. If I only had one model, which was 100% equities, and they'd say you're shoehorning all your clients into it. Even if I've explained to them that I've discussed equities, the client's done the risk profile, we've talked about long-term driver of returns, these equities, and I've allocated, the client's got enough cash.
We kind of went away from that allocation a couple of years ago on the basis that, well, look, our belief is that this is the right portfolio for you. If it doesn't suit your risk profile, we can dilute it down. So we get the same outcome really, but the client can dilute it down by any amount. They can dilute it down by 12%, for example, if they wanted to, and by just putting the bond side of things. So it's horses for courses. Anything else you want to cover before we move on to the Q&A session?
One other thing, really.
One more thing.
I like this statement, or rather this quote from David Booth. And I know we're going to go into Q&As, but it's relevant to my point. And he says, the most important thing about an investment philosophy is that you have one. And David Booth was one of the Dimensional founders, and he's executive chairman of Dimensional. And I think that any firm, any advisor listening to this, or even any individual that's listening to this, have an investment philosophy. As long as you believe in it and saying, do I believe in low-cost investing? Okay, do that. Do I believe that equities are the driver of return? And just buy it and leave it. And the best advice you can ever have is get invested, add to it, and just let the markets do the work. Stop looking at it. Stop buying and selling. Stop knee-jerk reactions. You've got to have a process and philosophy. And as an advisor, you've got to demonstrate and explain what that is, and then constantly show that what you're doing is correct. Review it, review the models, review the platforms, review the options.
It's a really good point. And we're going under the bonnet. So one of the things that we have is and this is unusual, is a separate investment policy statement. So it's separate to the client agreement, separate to the suitability report, investment policy statement. It details in there what our process is and what we do. We agree the portfolio allocation and get the clients to sign it off. And we revisit that annually.
Dimensional, we do as well. Dimensional, we're hugely helpful in helping us put ours together. It's like 39 pages, our IPS. And it's got all the data as to why we do what we do, why we believe what we believe. And I think some firms get their clients to sign it, but I can't imagine trying to explain that. If their clients want it of ours, we can email it to them, and it's updated annually, but it's too complicated and long-winded. Your job as an advisor is to make it simple.
Ours is about 4 pages. We have that document. That's our investment approach, which we send out to clients, but we don't ask them to sign that. Ours is more straightforward about, levels of risk and what we deem as low, medium, and high risk, that kind of thing.
But by the way, included in the show notes, I've included our 1-page PDF called Core Investment Philosophy, and it explains our 10 points. So if anyone wants to download that, they can do.
Paul, do you have any Q&As for us today?
So I do have 2 quotes, because you know me, I'll usually have about 5 to 10, but I've got ones that I really enjoy and really like. So the first one is from Jack Bogle, who was the founder of Vanguard. He's the father of index investing. He died a couple of years ago. Maybe I don't know when it was now, 2019 or something. He's about 90 odd. And he said, amongst many other things, he said, don't look for the needle in the haystack, just buy the haystack.
Cool. I like that.
And of course, it's to do with diversifying broadly as per market cap.
So a talk on investments wouldn't be appropriate without a quote from Warren Buffett. And he said, investing is most intelligent when it is most businesslike. So in other words, take the emotion out of investing, have a process, have a system, and follow it.
Like that. I like the back and forth here. So I'm going to go with Eugene Fama, who's a Nobel laureate, prize winner. He's the father of efficient market hypothesis. Again, he's one of the sort of original founders of Dimensional. And he said, active management is a zero-sum game before costs, and the winners have to win at the expense of the losers. After costs, it's a loser's game. And he's obviously explaining that why passive investing beats active investing in the long run due to cost efficiency. So he knows his stuff. He won a Nobel Prize.
He must do. Okay. And Warren Buffett's tutor or lecturer at university, Benjamin Graham, said, the essence of investment management is the management of risks, not the management of returns. And I'd probably go as far as say, that's also the essence of financial planning with clients, managing their expectations around risk, we talk far more, probably 10 times more about risk than we do returns.
We do. You've got to be careful not to promise returns, and we're going to talk in a future podcast, aren't we, about setting expectations for clients about market returns and other things. But yeah, I like that. And again, I'm so pleased that we included Warren Buffett and Benjamin Graham in there, because these are, titans of our industry, if you like, and they know their stuff.
Yeah, 100%. I think
usually
that, we didn't speak before them. They were probably the 4 key people.
Can we say as well that I'd like to invite any of our listeners to sort of send us any questions about investing or any points that they want to discuss, or give us their comments. Please do. Leave us we say to leave the notes on YouTube, which is easiest, or you can just DM us directly. I'm sure you'll find Warren and I via our respective websites. Yeah, it's been quite good today, I think, hopefully.
Anecdotes.
I
keep calling it antidote.
I've got the antidote, yes, which is
okay, so
what's
I'll go first.
Tell me your anecdote.
Then you can finish off. And this is actually a story that we talk and leave with clients. We actually share this in our investment presentation. In 2008, Warren Buffett made a $1 million bet with a hedge fund manager, Ted Sides. This was actually advertised in the New York Times, that the S&P 500 would outperform any actively managed hedge fund over a 10-year period. Ted couldn't choose a hedge fund. He actually chose a basket of 5. They were never named. They were always referred by their letters A, B, C, D, E. And despite the hedge funds using complex strategies, Buffett's simple index fund won by a huge margin. They actually closed a year early doing it. So proving that high fees and overtrading often underperforms a passive long-term approach.
Isn't it surprising that some of these hedge funds are so big? I mean, billions and billions, and some of the hedge fund managers are billionaires.
Yeah,
and
the fees 2 in 20, isn't it? Something like that they pay,
and they charge performance fees. I do have a joke actually, which is one that I try. It's not very funny, but I try to make it amusing for my clients. I'm there with a client I've been with for 10 years. They've got a big pot of money. I show them the performance since inception, and it's and some of our clients have made over £1 million net return. And I say to them in the annual return, oh, it's at this point, if you read the terms and conditions, that we apply our performance fee of 10%. Is that okay? If you could just write the check out to CASH, that would be great.
I like that. That's very funny.
I then say, obviously, I'm kidding, which is a shame, really, because deserve it, obviously.
Brilliant.
Should we wrap up, Warren?
Let's wrap up. Thanks, Paul. It's been great speaking with you today. And that's a wrap. So we'll see you in 2 weeks' time when we'll be talking about understanding retirement and the strategies that Paul and I use with our clients to help them achieve financial freedom. That's it. Take care.
See you guys next time.
Thanks for tuning in to the Finance Geeks. Don't forget to like, subscribe, and leave us a 5-star review. Drop your comments and questions on YouTube, and be sure to follow us on social media. Join us next time for more insights to boost your financial planning game.